Today, boom times are here. The DFA Daily to the 16th of April 2021. Hello again, it's Martin North from Digital Finance Analytics, working at his post covering finance and problem news with a distinctively Australian flavour. Well, judging by the most recent employment statistics and so many other statistics as well, everything looks, well, set fair, except of course there are a few questions still worth exploring. So today we look at some of those. And we also look at what the Fed has been saying about the yield curve in the US and what that might mean for future growth. Again, they say it's all set fair. But first, to the employment data. The seasonally adjusted employment, according to the ABS, rose by 71,000 people between February and March 2021. This latest data showed continued recovery in the labour market, with hours worked higher than in March 2020 for the first time during the COVID period. Employment and hours worked in March were both higher, up 0.6% and 1.2%. In fact, in March 2021, 62.6% of people over 15 were employed, which was higher than March 2020 when it was 62.4%. The proportion of women employed was the highest it's ever been at 58.5%, half a percentage point higher than in March 2020, while the proportion of men employed remained slightly lower than before the pandemic at 66.8% compared to 67% in March 2020. Western Australia's recovery from the lockdown in the first week of February was evident in a 2.4% or 33,000 people increase in employment and a 9.2% increase in hours worked, the strongest across all states and territories. Now, of course, the data was collected during the first half of March, so that's prior to the end of JobKeeper on the 28th of March. And so the April labour force release, along with weekly payroll jobs data, will show the state of the labour market after the end of JobKeeper. The participation rate increased by 0.2 percentage points to an historic high of 66.3%, with the female participation rate increasing 0.4 percentage points to a historic high of 61.8%, and the male participation rate decreasing slightly to 70.9%. Unemployment decreased by 27,000 people in March, and the unemployment rate declined by 0.2 percentage points to 5.6%. The unemployment rate remained 0.4 percentage points above March 2020, and that's around 62,000 more unemployed people. It's worth noting the youth unemployment rate declined by 1.1 percentage points to 11.8%, and that was underpinned by an increase in the number of employed young women, up 28,000 people, following a 31,000 increase in March. Underemployment decreased by 0.6 percentage points to 7.9% in March, which is below the pre-pandemic level, and continues to reflect some unseasonal changes in hours worked during the first few months of 2021. The underutilisation rate, which combines unemployment and underemployment, decreased by 0.8 percentage points to 13.5%. That was 0.5 percentage points below March 2020 and 6.6 percentage points below its peak in May 2020. Now, as the New Daily put it, with the more than 70,000 Australians finding new jobs over the month, that's around 2,280 every day, as the unemployment rate fell from 5.8 to 5.6%. The underemployment rate also fell to its lowest level since June 2014, indicating that employers have greater confidence in the economy and are giving staff more hours as a result. Treasurer Josh Frydenberg said the ABS jobs figures were, quote, another proof point of Australia's economic recovery gaining momentum. And economists at ANZ and Commonwealth Bank described them as very strong and incredibly strong, respectively, coming just one day after a closely followed index of consumer sentiment hit an 11-year high. The one obvious downside was the loss of 21,000 full-time jobs, which were offset by 91,500 new part-time positions. But APAC economist Callum Pickering says the longer-term trend in full-time jobs growth was a positive one. We've seen such strong full-time job increases in the previous 5 months, where 360,000 full-time jobs were created, that I'm just not that surprised that we saw a relatively small dip in March, he said. I wouldn't read too much into it. The data shows that more Australians had jobs and more hours were worked across the country in March than in March 2020, with female participation, or the proportion of working-age women either with a job or looking for one, increasing to a historic high of 61.8%, and the overall participation hitting a historic high of 66.3%. What remains unclear, though, of course, is how the removal of JobKeeper has affected the labour market. Treasury officials estimate that up to 150,000 people could have lost their jobs when the wages subsidy ended on March the 28th, but the figures do not capture this, as they refer to the first half of the month only. Equity economics lead economist Dr. Angela Jackson believes JobKeeper's removal will lead to an uptick in unemployment in April, the data for which will be released a week after May 11's federal budget. But whoever needs to find a new job will at least be starting their search at a time of record high job vacancies. Seek revealed on Thursday the number of job ads posted to its site in March was an all-time high, although ABS figures show there are still almost 3 unemployed Australians for every 1 vacancy. Overall, it is good news. The economy has recovered well, Dr. Jackson said. The question is, how does it go in the face of border closures in particular, and with the removal of fiscal stimulus over the next 3 to 6 months? Dr. Jackson said that the pace of the economic recovery would slow down if international borders remain closed for the foreseeable future. In fact, she told the New Daily some sectors relied heavily on migrant labour and therefore would struggle with skills shortages, which would weigh on the nation's productivity. The ongoing closure of borders for another 12 months has to present a significant challenge to the economy over that period. The tourism sector won't be able to recover, international education won't be able to recover, and they are important employers and growth industries, Dr. Jackson said. On top of that, we don't have those skilled migrants coming in again for another 12 months. Plus, you'll start seeing more people leaving as other economies roll out their vaccines. Notwithstanding the challenges, the strength of the labour market recovery, combined with the near-complete removal of domestic restrictions, has put a smile back on the face of the average consumer. The Westpac Melbourne Institute Index of Consumer Sentiment hit an 11-year high in April, in what Westpac chief economist Bill Evans described as an extraordinary result. He said the survey disproved initial fears that the unwinding of JobKeeper would undermine confidence. But the confidence boost is unlikely to materially improve the nation's record low wages growth. Wages grew at just 1.4% over the 12 months to December 31, and Reserve Bank Governor Philip Lowe believes we are unlikely to get a decent pay rise until unemployment falls to 4%, something which hasn't happened since 2008. Returning to where we got there before the crisis, we've got there before we expected, but the economy wasn't travelling that well before the crisis, Mr. Pickering said. Most economists were talking about rate cuts even before the pandemic hit, so merely getting back to where we were isn't really getting to where we want to be. So I think the federal government needs to aim higher. And talking of the federal government, they should stay out of the housing market, says lenders, according to an article in MPA. Australia's two largest home lenders have argued that the government should not meddle with the housing market, despite predictions of a price surge of 10% this year. Commonwealth Bank Chief Executive Matt Comyn told the House Economic Committee on Thursday that the residential market was very strong in February and March, but was likely to be a bit weaker this month, according to a report in The Australian. Despite its predictions of a weaker April, CBA upgraded its price growth forecast for the year from 8% to 10%. And Westpac Chief Executive Peter King made a similarly bullish projection for 2022. There is not a lot of turnover in the market, and stock is very tight, so houses are being well bid, King told the committee. Comyn and King both said that macroprudential intervention by the government was unnecessary because conditions were different from the last housing boom. Comyn said that riskier investment lending accounted for about 60% of applications in 2015 compared to just 24% currently. Moreover, during the last cycle, prices were skyrocketing in certain areas, unlike the broad-based recovery currently underway. So we see this as a much lower risk cycle than previously, Comyn told the committee. And King said riskier categories of lending, high loan-to-valuation loans, interest-only loans, and investor lending were, quote, much lower than we saw at the last peak, and up a little bit, but not much, on the last 6 to 12 months. And during the Economic Standing Committee hearing for the review of the four major banks and other financial institutions, Westpac CEO Peter King was questioned specifically about the bank's turnaround times for mortgages. He attributed longer loan approval times to moving processing roles offshore in 2020 and responsible lending checks and balances, adding that it is looking to improve the process. The deputy chair of the committee and Labour member for Fenner, Dr. Andrew Lee, quoted figures from Momentum Intelligence Brokers Pulse survey for February 2021, which found that Westpac's average turnaround times for broker-lodged loans stood at 20.5 days. However, it's worth noting the data from the March 2021 Broker Pulse survey released this week shows that brokers are reporting Westpac's turnaround times have since reduced to 13.7 days. Dr. Lee asked if the blowout in turnaround times could be attributed to the bank's offshore processing centre shutting down as it moved to onshore 1,000 jobs to support its call centres and loan process. He said the February 2021 Broker Pulse survey found that Westpac was rated the worst of the reported banks. Your time to initial credit decision was 20 days. There was some suggestion that this was to do with an offshore processing centre being shut down. Is that all that was going on? Or are there more systemic issues that lead to your approval times being so long? He asked. In response to Lee's question, Mr. King said, "We have a job to do in improving our mortgage processing times, and we're well underway. As that report referred to, we did have some issues in our offshore processing areas, but we actually made the decision last year that we would bring back 1,000 roles to Australia, and they include call centre roles and the critical mortgage processing roles." Mr. King told Dr. Lee that 476 roles had been brought onshore so far, which he said would improve the bank's process. He continued, "I think we've also got to look at our process to approve the mortgage. So how can we improve the processes? I think we've put in lots of checks and balances for responsible lending. Probably on the verification side, we had too many checkers. So we've got opportunities to speed up the time through having one check, not multiple checks." Dr. Lee pushed Mr. King on his answer, asking, "But you will appreciate that this is an extraordinarily long amount of time to be taking, right?" The best performers were ING and Macquarie Bank, where they were taking 4 days. Average turnaround times at Macquarie was just 3.6 days in February and 3.8 days in March, while ING's turnaround was 4.1 days in February and March. You're more than 2 weeks behind them. Your approval times are 5 times as long as the best performers. That must really make you worry, mustn't it? The Westpac CEO replied, "It's a very big focus for me to improve." And Mr. King revealed that Westpac approves around 12% of loans within 2 days, which the bank can fast-track further if the consumer requires it. If someone says to us, "I need an approval in 2 days," we have a fast-track process as well, but we're too long across the board on turnaround. And the CEO added, however, that not every loan was the same, and some more complex loans took longer to process. When you get into family trusts or complicated families, they can take a long time. So for simple loans, they can take much quicker. But I should say, I want this improved, and it's a goal for the company to improve it. Committee Chair Tim Wilson asked Mr. King whether there was discrepancies in turnaround times between the broker channel and the direct lender channel. While Mr. King acknowledged that applying directly with Westpac would result in faster approval times, he could not provide specific data on the difference in approval times between the two channels. He said that the two channels produce different volumes and require different processes. When pressed by Mr. Wilson if there was an inherent favour of borrowers approaching the lender direct versus a mortgage broker, Mr. King said no, we'd ideally like both to be fast. And Dr. Lee expressed concerns over borrowers missing out on purchasing a home as a result of delays in approval times, and asked Mr. King if the bank systematically tracks the number of borrowers who've missed out on a property purchase. Mr. King repeated, if a consumer says to us they need a quick turnaround, then we respond to that. So in terms of customers' complaints on mortgages, I'd have to take that one on notice. We're tracking the bifurcation. I'm not sure that we know every time someone misses out on a house. Often they're getting finance from multiple places. And Mr. King said that while the team supporting the borrowers could track those missing out on purchases, it's not something that I look at. I look at the complaints when they come in. And the Westpac CEO comments followed those by Matt Common from the CBA, who told the committee that the time to yes for home loans was different depending on the channel. When asked what the current turnaround times was, Common said it would be within 2 days, certainly in the proprietary channel. And in the broker channel, it could be slightly longer than that at the moment. And interestingly, Citi has announced that it's going to exit the Australian consumer business. The investment banking company has announced that it is looking to sell its consumer banking business in Australia and 12 other markets. Citi has commenced a sale process of its Australian consumer business, which includes mortgages, credit cards, retail banking and wealth management for high net worth individuals. The sale comes as Citi looks to exit its consumer banking businesses in 13 markets, including Australia, following a strategic review, which it undertook to focus its investment and resources to the business that can drive stronger growth, deliver scale and improve returns over the long term, it said. In Australia, the sale of the consumer business will enable Citi to focus its investment and resources on its institutional business, which includes investment banking, capital markets and advisory markets and securities services, commercial banking and treasury and trade solutions. Citi Australia CEO Matt Littett said Citi's consumer bank in Australia is an attractive and profitable business employing highly skilled and dedicated team members. Citi is committed to securing the best possible outcomes for our employees and our customers. And he added that during the sale process, which is subject to regulatory approval, there will be no change in the way Citi serves its consumer banking customers. Citi Australia largely operates a digital model, with more than 99% of its clients coming to Citi via digital channels. It also has a strong broker offering after having broadened its offering in 2019. Under Citi's new strategy, new consumer banking strategy for Asia and Europe, Middle East and Africa, will focus on 4 wealth centres in Singapore, Hong Kong, London and the UAE. It said it would continue to serve existing clients with a full suite of products, from these 4 hubs. And now more on Australia Post, as discussed in the conversation. Queensland's National Senator Matt Canavan, juggling a couple of committee engagements, hadn't planned to attend Tuesday's hearing, at which former Australia Post CEO Christine Holgate appeared. But party elder Ron Boswell was insistent, telling Canavan he must be there in the room fighting for Australia Post small business licensees. Boswell, himself a former senator, retains one of the best political noses in the business. He'd spoken to Canavan soon after the Holgate affair blew up last October, warning the issue was trouble and needed to be fixed. Canavan was initially sceptical, thinking people would react against the cardio watches she'd given for executives as a reward for a deal with banks to shore up Post's licensing network. But he's come round to Boswell's thinking. The government has been somewhat dismissive of the campaign the licensees have waged in support of Holgate, but Canavan judges that many small post office businesses in regional areas could pack quite a punch in next year's election campaign if they chose. And in those areas in Queensland, the Nationals are competing with One Nation. At Tuesday's hearing, Canavan wasn't backward. It was he who put to the Post's chair the pointed question, given that, as you say, Miss Holgate has a lot of support amongst your employees and important clients and suppliers, and given that Miss Holgate this morning has called for your resignation, would it not be better for Australia Post if you were to leave now as well? It was a reasonable proposition, but the chairman said he wasn't going anywhere. What has been notable as Holgate lashed out at Prime Minister Scott Morrison for bullying her with his parliamentary tirade, and the chairman not backing her, is the breadth of her constituency of support. It includes business figures and respected financial journalists, as well as the licensees. With her claim gender was a factor in how she was treated and the suffragette white attire, she has now astutely tapped into the new women's movement that's arisen off the back of the Brittany Higgins issue. In doing this, she's hit Morrison where he's particularly vulnerable. Politically, her advocates stretch from Green Senator Sarah Hanson-Young to One Nation's Pauline Hanson, who was the moving force behind the Senate inquiry. The bedfellows might be somewhat uncomfortable with each other, but it's a big bed. The week left Morrison and the government on the ropes over Holgate's treatment. References to luxury watches lost much of their shock value. The government can only hope the issue will simply fade with time, as issues do, except that those small business operators mightn't forget. There's an interesting contrast in how Morrison is currently dealing with Higgins, who alleges she was raped by a colleague in a minister's office, and with Holgate. The PM has reaffirmed he plans to meet Higgins. She's indicated she's not keen on re-entering Parliament House, so he's willing to arrange another venue. He says he's looking forward to hearing what she has to say. Holgate, who wants an apology from Morrison this week, asked him to call her, but he rejected that as unnecessary. Outstanding issues are between her and the Post Board, he said. That may be true. By the same token, not to make the gesture is discourteous at the least. Remember, this was an executive who performed extremely well at Australia Post and who came out of the inquiry into the watches affair with only minor points against her. Neither Morrison nor the two Australia Post shareholder ministers, Communications Minister Paul Fletcher and then Finance Minister Matthias Cormann, spoke directly to Holgate on October the 22nd, the day Morrison excoriated her in Parliament. Again, they would say that was a matter for the chairman, and again, they would be technically right, but given the stakes, wouldn't one have thought Fletcher in particular might have sought to make direct contact? Holgate's appearance in the Senate inquiry not only gave a detailed insight into the behind-the-scenes events of that October day, but also revealed some of the arguments that had been going on about the future of Australia Post. She produced part of a review by consultants BCG the government had commissioned that canvassed cost-cutting measures and the possible sale of Post's parcel section, she and the management team had pushed back against cutting services and jobs and opposed divestiture. So before the Watches affair, the government was already to a greater or lesser extent irritated by the forceful head of this government business enterprise that some Liberals would like to see part or even fully privatised. As speculation grew after her evidence about the BCG report, Fletcher on Wednesday said the government had no plans to sell off the parcel service, which performed strongly over the pandemic. Anyway, probably any attempt to do so would run into vigorous resistance from the Nationals. The government hasn't released the BCG report. Obviously, it canvasses important issues about the business and should be in the public domain. But who is surprised? It is of a piece with this government's penchant for secrecy. If it can get away with it, not that it's alone among governments here. It even tried to hold back the report into Holgate and the Watches until public pressure made that untenable. Further afield, among the advantages from the government's point of view of the National Cabinet is that much more can be kept in confidence than in the old Council of Australia government days. Crossbench Senator Rex Patrick has a test case in the Administrative Appeals Tribunal for the release of minutes from the National Cabinet, which has been crucial in the pandemic decision-making process. Patrick says he wants to expose the government's secrecy overreach and to open the document vault for others to look in and see. Morrison this week talked about how Australia Post must be accountable, but his government likes to minimise the extent of its own accountability, especially when awkward issues surface. And it's worth remembering that if we didn't have Senate inquiries like the Holgate one, we would get ever less information. Question time, at least in the House of Representatives, has become almost useless as a means of holding the government to account. There is a report imminent from a House committee about how to improve it, but you'd have to be an optimist to see a prospect of qualitative change. But in the Senate Committee on COVID, the inquiry into the Holgate affair and the regular estimates hearings on a range of issues have forced some transparency and accountability. And finally, this from the US Fed. The question is the yield curve potentially a predictor of future growth? And they wrote, in recent weeks, the steepening yield curve has become a topic of conversation among market participants. For starters, the slope of the yield curve can be measured as the difference in nominal interest rates between long and short-term US Treasury securities. Using the spread or difference between the 10-year and 2-year constant maturity Treasury rates, that's the most common maturities used when referencing the yield curve, the difference in those yields has more than doubled from an average of 0.48% in July 2020 to 1.14% in February 2021. This increase in spread has been driven entirely by an increase in nominal yields on the 10-year Treasury note, as the Federal Reserve, through open market operations, has driven the yield on the 2-year notes close to zero. So the question is, what does the increased nominal yield on the 10-year note imply? And why is it a source of angst for financial markets? Well, one view is that the increase in 10-year yields is driven by a belief in the financial markets that fiscal and monetary stimulus throughout the COVID-19 pandemic, together with the timely arrival of vaccines, has been enough to generate expectations of higher economic growth in the future. Another view is that under the new framework for monetary policy, a seemingly positive economic expectation is causing the fear that this growth will generate higher inflation rates than those witnessed in the last decade. The increase in nominal yields may be problematic of future growth, as borrowing costs with longer maturity dates tend to increase with Treasury yields, and this phenomenon makes long-term investments more costly. There is a very simple way to determine whether financial information contained by the yield curve has generally been accurate in their predictions of future economic growth, and that is to check whether positive changes in the yield curve slope are a leading indicator of growth in the real economy. So in this figure, generated using the charting tool available by Fred, they plotted the spread between the 10-year and the 2-year Treasury constant maturity rates and the growth in total non-farm employment expressed as a percentage change from the previous year for the period from 1990 to the present. And they chose to use the growth of employment as a proxy for economic growth because it's a higher frequency data set than gross domestic product estimates, as well as being more tangible to the general public. Employment status is a more concrete indicator of the economy than output. And the figure shows that the yield spread in general is negatively correlated with growth in employment. Peaks in employment growth following peaks in the spread towards yields in the 10-year and 2-year Treasury notes. In addition, the spread is widest generally following recessions when expectations of future growth are highest after a trough in the economy. This pattern appears generalizable and consistent over the past 25 years. Another way to put more structure onto the previous figure is to measure how the yield spread has co-moved with future employment growth. And the next figure establishes this relationship by depicting the correlation of the 10-year, 2-year yield spread for a given month and the actual employment growth various months later. As observed in the first figure, initially the correlation between employment growth and the yield spread is negative. However, as you look further ahead from the current month, the yield spread's correlation with future growth becomes increasingly positive. This relationship is very smooth and also exhibits concavity. In other words, the correlation between the two variables increases each month, but by a progressively smaller magnitude. The peak of correlation occurs around 30 months or 2.5 years in the future. After 2.5 years in the future, the correlation begins to decline somewhat, but remains relatively high. So this pattern of historic correlation between the yield curve slope and future economic growth, approximately 1.5 to 3 years in the future, implies that the yield curve has been a reliable and consistent indicator of future economic growth trends. If this historical trend remains constant, it is likely that the US economy will experience increased economic growth in the next few years, as the market expects. To what degree this expected growth will generate inflation remains to be seen, they said. However, with the Federal Reserve holding down short-term interest rates, it seems likely that borrowing costs will remain relatively low for the foreseeable future, and financial markets are signaling the expectation and likely realization of higher economic growth in the next several years. Now, there's a couple of interesting observations there. The first is, of course, the question of inflation or deflation ahead isn't really addressed by this. And the other point is that there are some unique things going on at the moment with the quantitative easing programs and the fact that liquidity is still growing, which may distort the information. But nevertheless, the Fed is clearly of the view that growth is coming, and it's going to be good growth. And so wherever you look, there is information that would signal boon times ahead. However, just a few cautions. Looking at our own data in Australia, what happens now next month when JobKeeper and JobSeeker has ended, that may have an impact. With regard to lending standards, my view is that we do need to be considering macroprudential intervention now because home prices are moving away and debt is rising too fast. And in the US, the Fed's strategy, to my mind, is probably not going to end up where people expect it because all the evidence shows all this quantitative easing is not necessarily hitting the real economy yet. And whilst the growth is there, it's really very artificial thanks to the liquidity printing. And that liquidity printing either goes on forever or it has to be stopped. If it's stopped, then all bets are off. If it continues forever, then that means ever lower rates, ever more debt. And the question is there a limit? How much debt is too much debt? Well, I guess one day in the future, we'll find out. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.